So there's basically, in terms of how the bank lends money, there's basically four scenarios that they'll look at, and everyone here will fit, or first home buyers, everyone here will fit one of these. The first one obviously is the most basic one, and that is you have a 20% deposit. The bank will then lend you 80% of the loan, and you've got to cover the stamps. Okay, if you can do that, then you'll get all the best rates, and most banks will take you, there'll be no issues at all. A lot of people don't fit into that group though, because 20% deposit is quite large, as you guys probably know. The second group is the anywhere between 80 and 90% lend, which means you have a 10% deposit, maybe a little bit more, and you're looking obviously to buy a house straight away before you get to that 20%. The banks will do that, there's no problem at all. The problem with that is though, you will end up paying LMI. Now that stands for Lender's Mortgage Insurance. I don't know if anyone here knows what that is, or I'll tell you anyway. Basically, Lender's Mortgage Insurance is an insurance that the bank takes out against you, because once you're over 80% LVR, you become a risk to the bank. So they take out that insurance against you, and then they charge you for it. So it basically is worked out on a sliding scale. If you are at 81% LVR, your Lender's Mortgage Insurance, hypothetically, it will depend on how much you borrow, but let's say it's $5,000. If you're at 87%, it'll be up $10,000 around that area, and so on, like that. If you're borrowing $1 million at 90% LVR, you're looking at around 35, 40 grand LMI. So if you can avoid it, avoid it. Having said that, if you're around the $500,000 mark and you're at 85%, you're probably looking at about 5 to 10 grand. How they charge it to you is they capitalise it to the loan. So if you have a $500,000 loan, you've got $10,000 LMI, it'll be a $510,000 loan, which you just pay off over the 30-year period like you would anything else. When you work it out like that, repayments for LMI are about $20 a month or something like that. Having said that, if you can avoid it, avoid it. The next 2 points are good ways to avoid it. So another situation would be if you do have that 10% deposit, and you don't want to pay LMI, but you need to borrow 90%, you can get a parental guarantee. What that is basically your folks are happy to put their house down as a security. I'm sure everyone here will be able to do that. If you do that, and we're seeing it a lot lately, basically you're covered up to 80%, your property that you buy is the 80% security, and whatever your parents are guaranteeing is the extra percentage. So if you do that 90% loan with the 10% parental guarantee, then if anything did go wrong, the first thing the bank would do would be sell your house if you defaulted on your loan, and then they would recover anything that you couldn't cover from that 10% from your parents' property. Now in this market, you would like to think that if they did sell your house, if something horrible went wrong, they'd recover the full amount anyway, but warning. The next one is basically you need to borrow the entire amount, which you can do. Once again, under the parental guarantee, you can borrow up to 105%. So if you need to borrow the full amount and stamps, you actually can do that. Now, whether you want to do that or whether you guys recommend stuff like that, I'm not sure. It is up to you. It does say there a deposit bond. I'll touch on that later on what that is. But basically, as long as your parents are happy to go on as guarantor, you can borrow the entire amount of the property, and their security is only liable for that 20 or 25%. Make sense, everyone? Mm-hmm. All good? If you have any questions, by the way, just yell out. I'll run through this stuff pretty quick. So, deposits obviously are required from the bank, as we went through before. 10%, 20%, whatever you need to use as a deposit. There's 3 ways to do it, obviously. The second one's going to be fun. Savings is what Ben just spoke about. I know it's really hard to save up. I had to do it, and it wasn't much fun. I did get help from my parents though. Parents is the second one. This is something you need to talk to your folks about, or whether you want to chip in. Obviously the banks don't care. If your parents pay the deposit, they don't care at all. They're worried about the loan, not so much how you got in there, into that position. A deposit bond is another way you could basically borrow to get your first deposit. What it is when you want to buy your house, obviously you put down your deposit at auction or whenever you do your private sale, and then you've got, usually it's 60 days till settlement. The bank will give you your money at settlement. So if you're borrowing 100% or 90% or 80%, the bank will pay that at settlement. But if you don't have the deposit on the day of purchase, and obviously you can't borrow the money or something like that, you can get what's called a deposit bond. There are companies that do it. Come and talk to me afterwards if it's something you're interested in. But basically, these companies will give you the deposit for the house, and then you just pay them back at settlement. So you'd have to borrow, right up at 100%, 105% if you need to pay stamps as well. Make sense, everyone? All right. Yeah, let me just refer to my little sheet here. Borrowing power. This is sort of what the bank's going to look at when they decide on how much they're going to lend you. Before I get into that, I will just mention the Royal Commission because I don't have a slide on that. Sorry, Tony. Basically, the Royal Commission, you probably heard a bit about it. All that it's affected at the minute is this, the borrowing power. What the banks are doing now, and I don't have a slide for it, sorry, is they're looking at your living expenses a lot more closely than what they used to. So maybe a year ago, maybe 2 years ago, the bank would look at everyone here and each individual, they'd have a number for as a living expense. So it'd be $2,000 a head. So if you came to me and said, I'm looking for a loan, I'd have to put your living expenses down as $2,000 if it was one person. Now what the banks are doing is they're itemising everything. So they're going through your insurances, they're going through your spending. And when I say that, everyone looks scared. The smaller banks are doing it a lot more thoroughly than the bigger banks. ING, Virgin are the worst. Virgin are looking at everything at the minute. They're looking at, I had a guy get declined the other day because he had a sports bet transaction on his account. It was just madness. He was borrowing 40%. It was just crazy. Anyway, so Virgin, we've stopped using them because of it. But they're looking at all expenses, everything you do, credit card statements, bank statements, the whole lot will be looked at. If you go to an ANZ or a NAB or something like that, not as stringent. So they'll simply look at your savings. They might look at your transaction account, but they won't look at your credit cards or anything just yet. The Royal Commission's changing things. It's getting a little bit scary, and when we're doing loans at the minute, the first thing I'm saying is it's taking longer than you think, because it really is. They're really annoying. We used to be able to turn these around in 2 weeks. Now it can take almost, can take up to 3 to 4 weeks just for them to go through everything at the smaller banks. The bigger banks are not too bad. Having said that, what they're going to look at is your income is the main thing they'll look at the bank. They want to know you can service a loan. So they'll work out, when you come and talk to someone like me, I can work out basically how much you can borrow, and it's based on basically how much you're earning. There's different ways they look at it. I think the next slide I'll go through that. If you're struggling with income, you can get help from your parents once again. Parents are going to shoot me after this. You can use a servicing guarantee. All banks have different rules on servicing guarantees. All it means is that the bank will look at your income, great, and then they'll look at your parents' income, and they'll hold them accountable for repayments on the loan. Not many people do servicing guarantees, I've got to admit. A lot of people do security guarantees. So, there's a few little tricks we can do. The reason I've written investment property there, even if you're buying your first home, if you want to borrow $500,000 and the bank's only letting you borrow $400,000, you can tell the bank that it's going to be an investment property, and what they'll do is they'll take an income out of it. So if you're living with your parents or something like that, it doesn't really work if you're renting yourself, but if you are living at home, the bank, they don't charge rent because you're living at home. So then you just tell them that, and this is obviously my job to come up with these strategies, but we can tell the bank that you're going to buy an investment property, they'll take an income out of it, all of a sudden you can borrow 400, 500, 600,000. Now, we wouldn't want to put you in a position where you can't repay the loan, so we look at that as well. When the bank looks at your repayments and things like that, you'll get an interest rate, most people around 4%. The bank will have they call a servicing rate, so they'll work out your repayments based on, all banks are different, but usually around 7.5%. So you've got that buffer zone. So if interest rates go up, they're not so nervous that you can't repay your loans. This putting parents on the title, we don't do a lot, to be honest with you. It is an option, but you would have to split the loan in half. So basically, parents would have to go on the title with you and on the loan, and the repayments would be split down the middle. Whether that would suit people here, I'm not sure. To be frank with you, I've never done one of them. There's a little trick here, is to reduce your liabilities before applying. As I said, the bank's going to look at everything. So if you've got any credit cards, car loans, also got their HEX debt, the bank are going to look at it, and it's going to affect your borrowing power. Good thing about that is, if you've got some time up your hands, you can reduce your credit cards. When I say that, the bank will look at your limit. They won't look at how much you owe. So if you've got a $30,000 limit, the bank will actually look like you owe $30,000 on this card, and they'll work it out at about 3%. So if you can just reduce that limit to 8,000 or 6,000, all of a sudden you can borrow an extra 50,000. So things like that are really useful. Car loans, if you're thinking about getting a car loan before you get a home loan, don't do it. They're quite significant when it comes to borrowing capacity. Obviously, because car loan repayments, they're usually around $1,000 a month. Some of them. That's $1,000 a month that the bank, will take off your home loan repayment. So it can cost you, $100,000 on your home loan. So if you're thinking about getting a car loan, I would get the home loan first. If you've already got one, look at your options of paying it down. If you can't, obviously you can't, but they're just strategies. HEX debt's another one. The bank will work out your HEX debt based on your income usually, not how much your HEX debt is. So if you've got a $3,000 HEX debt, and you sort of think, oh, that's only $3,000, the bank's not going to worry about it, and you earn $100,000 a year, the bank will actually work out a repayment of 8% of your income per annum, and they'll use that monthly. Even though if they did that, you could pay off that HEX debt in 3 months or 4 months. They don't look at it like that. They look at it as a 30-year thing. So if you can get rid of your HEX debt, get rid of your HEX debt. You look concerned. It is concerning. Okay, so when you are doing a loan, these are the sort of things that the bank are going to look at. Once again, this is generic. If you can't fit in here somewhere, there are other banks that can help you out. So usually it's 3 months genuine savings. That means that the bank, they obviously want to see that you can save and the money's been in your account. So they will ask for 3 month statements to see your deposit saved up. Account activity, which I mentioned before, I wouldn't stress too much about that. The sportsbet thing was a one-off, but they are going to look at everything. So it's more annoying than going to affect you, but it is really annoying. Most banks are going to look at 6 month statements now. I did touch on the difference between big four and smaller banks. The smaller banks, and I'll run through interest rates in a minute, but the smaller banks, your interest rates are going to be a little bit lower. And the bigger banks, they're going to be a little bit higher. When I say a little bit, I mean about 10 basis points usually. However, the smaller banks are harder to get into. They ask more questions, but they take a lot longer to get the loan across the line. So if you end up buying a house and there's a 30-day settlement, I wouldn't even look at a smaller bank like an ING. I'd go straight to an ANZ or an NAB, because if you miss settlement, obviously there's penalties and all sorts of fun stuff as well. PAYG, basically that's how they're going to look at your income. Most banks will look at your last 3 months if you're PAYG, and they'll just average it out. So if you get commissions and stuff like that, and you can somehow get them in that 3 month period, it will increase your borrowing powers. Self-employed, at the very least, they're going to look at 1 year's financials. Most banks look at 2 years. ANZ look at 1, that's why I put it in there. ABN, usually a 2 year ABN is required. The best I've ever seen is 6 months, that's why I put that in there as well. So I don't know how many people here are self-employed. If you are, get your financials at least for 1 year, and obviously get them as high as you possibly can. Casual employment. I don't know if anyone here is a casual employee, but basically what they do with casual is they'll look at your pay slips over the last 6 months and they'll average out the pay, pretty similar to PAYG, to be honest, and that will determine your borrowing power. Probation periods, they don't really matter. They do, Tony looking at me funny, they do matter. It's just going to, once again, determine which bank we take you to. If you've just started a new job, we might have to look at a smaller bank like a Liberty or something like that. If you've been there for 3 months, you're usually pretty safe. And maternity leave's another area. Every bank's different. We can, as long as you're going back to work within 12 months and you can get a letter saying that from your employer, it's usually not much of a problem. Where are we? Interest rates. Okay, so interest rates used to all be the same, no matter what they were. Interest only, principal and interest, owner-occupied, and investment, they were all the same. The last 2.5 years, the banks have decided, based on APRA, I think, they've split them all up. So now you've got the owner-occupied principal and interest repayment. That's the lowest interest rate you'll get. You can get around 3.64 for that at the minute. That's at, where are we? That's at Virgin, which I've just told you not to go to. But at Virgin and ING, you can get about 3.64. If you go to a Big Four bank, and obviously it depends how much you borrow, let's say you borrow $500,000, you're looking at about 3.75 at a Big Four. So it's not that much of a difference. I would recommend going to a Big Four in that situation, just because I've seen the pain of the little ones. With the interest only, you're going to pay a little bit more. Just so I don't get this wrong, I wrote it down. So interest only, the lowest we sort of areas at the minute are 4.09 for owner-occupied interest only, and if you go to a Big Four, it's around 4.2. Investments, 3.99 is the best principal and interest investment I can see at the minute. Once again, these change all the time. If you did go to a Big Four, you're looking at sort of 4.4. So you can see the difference there. Ultimately with this stuff, it's going to be what suits you and what you're advised to do. Whether you want an interest-only investment or owner-occupied principal and interest, it's got to be what suits you guys. If you can't afford the repayments, on the P&I and you want interest only, you should really be looking at whether you're borrowing too much money. That's that. This is pretty much the end. The last things I'll say is, if you are looking at buying a house, get a pre-approval just from a bank, or come to me and I can help you out. But basically, that'll let you know how much money you can borrow before you go and buy a house. The last thing you want to do is buy a house before you can't pay for it. So get a pre-approval. And yeah, apply for more than you think you need. It's really easy to reduce the amount you've applied for. So if you get approved for a $600,000 loan and you only need $500,000, that's so easy to do. We just call the bank. If it goes the other way, really hard. So go for more than you need, so you're not stuck at option going, oh,